Who is the chief economist at FNB, and I've also got Ian Scott, who is head of fixed income as well at Momentum Investments. Thank you so much for joining us, guys. Mamelo, let's kick things off with you. The expectation here was indeed for interest rates to remain on hold. Do you think that they sat on their hands a little bit here?
Look, I think it was a tough one. I think we see it in the split in votes, with 3 people voting for interest rates to go up. And I think a very important thing was highlighted in the statement, that demand remains quite weak. We saw it in the inflation print that came out yesterday, that core inflation remains relatively low. So although we've seen all of these shocks, particularly the rand and the petrol price having an impact on headline inflation, underlying inflationary pressures remain quite weak. And I think that the governor is right in saying that they are going to wait to see if there are second round effects to the inflation outlook, and they will look at the risk and assess the risks and act when required to.
Ian, no pressure indeed by the looks of things for the Reserve Bank to act when you take a look at the fact that inflation, the forecast itself, is set to perhaps peak at 5.9%. So it doesn't actually go outside the band, although it does peak outside of that. Do you think that they will fear that anything that happens means that they may have to move quite quickly?
Well, the SABC is in a very tight position because we know we are in a recession, technical or not, we are in a recession. The consumer is really under fire. I think there's no easy decisions for the SABC at the moment. I think if they had to make the choice, and I think they did it this afternoon, is to keep rates where they are. I think the risk is that they feel, should they act when emerging markets are under pressure or not? But if I look at domestic fundamentals, I think it's quite important to try and keep the rates as low as long as possible, not to put the consumer, which is already under fire through petrol prices and VAT and all the other prices in the economy, not to increase interest rates as well as for as long as you can. I think we need to stimulate growth in this economy because we already have high real rates. This is not a high real rate story, it's a growth story.
Yeah, almost unmoved is the R186 that in the bond market, still above 9%, however. Do you feel that this still doesn't make us competitive in that market?
I think we're very competitive. If I go and look at over long term, the South African bond market, we feel, is probably one of the most compelling arguments in the fixed income sphere. If you look at a very long history, your 10-year bond should give you around 2.5% real over inflation. So if inflation over the next 2-3 years, as predicted by the SABC, averages around 5.5%, and you're getting a 9% yield on the government bond, that's 3.5% real. We think that's a very good opportunity given all the other risks in financial markets. We like the real yields. We think it's one of the allures of South African markets at this point in time is the high real yields we already have before we have rate hikes.
Mamelo, the governor also speaking there that you certainly need just one event to change things around. We could have a petrol price increase of more than R1, which is exactly what is expected next, to certainly hurt that inflation figure. How much pressure does that put on the Reserve Bank to keep vigilant and ensure that they don't fall behind?
I think it's quite important to look at sort of these external shocks in isolation. So when we do get a currency that depreciates, we do see the first impact through the petrol price, and it then filters into the headline inflation number. But we also need to think about, these massive increases that we're seeing on a year-on-year basis, with the disinflationary impact that it's going to have over time. Sure. So I think that they will look at the shocks in isolation, but I think that we need to look if there is demand pressure in the economy. So if we think about, I think the last 2 statements where the Reserve Bank had anticipated that core inflation would rise to 4.7%, we are at 4.2%. Our core inflation actually moved back a little bit in the last print, showing that there isn't any demand pressure. And I think that will be quite interesting to see if we actually get second round effects and how massive they are. So I think that they will look at these shocks in isolation and see how they sort of pan out over time. Yes, we did see the currency weaken quite a bit between July and August, for instance, but it has come back quite a bit. So I think that they'll be cognizant to look at those shocks properly.
Yeah, you speak of the rand. Just about as of 10 minutes ago, it was at around 14.38, which is the exact same market was at actually just before the governor announced his interest rates decision as well. Things like the rand, things like emerging markets, you've seen a constant hike in interest rates from Argentina going right up to 60%, Turkey going up to 24%. The currencies of emerging markets are continuously struggling. Is he perhaps falling behind the curve? Or is it the fact that we're not facing as big a crises as some of those countries?
Yes, I think we need to look at the idiosyncratic factors that have driven the currency weaknesses in those specific economies. Yes, we've seen that there's been this massive outflow of portfolio flows out of emerging markets on the back of trade wars and, concerns around China and so on. I think that, it's been overdone. We are anticipating that, the currency should retreat, and it has. It's at 1430. So I think that they will look at those factors, and I think he mentioned in the statement that in the short term, fine, there are local idiosyncratic factors, even though he said he doesn't want to go into detail about what they are, which are not in the control of the central bank. And I think they will be cognizant of those things, that we do see fluctuations in the currency, but we need to look at sort of the long-term inflation outlook, and if they are anticipating sort of continued currency weakness, I think then they will react if the currency is expected to weaken over a long period of time. But as we know, the rand is highly volatile, and I think that they will take all of that into consideration before making a rate decision.
Let me ask both of you a question. Ian, you first. Had we not entered a technical recession, do you think the decision would have been different?
No, I wouldn't, because even if we didn't have a recession, growth would probably still be low. So if you look at the SABC forecast, we still have an output gap. And I think it's hard for an inflation targeting central bank to hike rates while you've got an output gap. I think the risk that the SABC doesn't want to run, the worst position for a central bank is to have stagflation, so low growth and high inflation, and you probably want to avoid that type of situation. So, all things being equal, I think the SABC may have not even hiked, because growth would still be low if it wasn't negative. Yeah,
Mamelo, same thoughts?
I think, the recession probably did sway the arm of the Reserve Bank not to do anything. But I think at the same time, they will focus on what they're mandated to do, which is managing price stability in the market. And they will look at whether there are risks to the inflation outlook and act based on that. Historically, we've never seen the Reserve Bank actually hike rates in a recession. We've seen them historically hike in a downward phase, not in a recession. So I think that did definitely have an impact.
We're still certainly in that downward phase, and I mean, we'd get data out of the Reserve Bank very soon to perhaps continue to tell us that, although there's a lot that goes into telling us whether we're still in a downward phase or not. But Ian, if the economy continues in this manner, and yet inflation remains at higher levels, it seems, however, that 4.5 seems to be the key mark here beyond anything else. Do you think then that they will be forced to make some sort of decision on hiking or not hiking, particularly going down on interest rates, if growth remains as weak as it is?
Well, it's hard to predict what the SARB will do, because we don't know what the currency will do over the next 6 or 12 months. But let's say the EM contagion continues and we see more hikes in other EMs. I think the pressure will build on them. They may hike, but may only be in 2019. But I think what's much more important is the hiking cycle would be a lot shallower than what you would think. So we're probably not going to see 2% of rate hikes. Maybe we see 50 basis points of rate hikes or that type of thing. So it's going to be a much lower.
They've never gone that high. You've never really seen them try to be that aggressive when you see an interest rate hike. So you think something like that is still a possibility, though, with the current Reserve Bank governor?
Yeah, I think they will have a muted cycle because growth is so low. Because the last time we really had aggressive rate hiking cycles was probably in the Tito Mboweni era, when we had 4% cycles up and down. We're probably not in that phase, because we are growing at less than 1%, and I think the prediction for next year is around 1.8%. So we're not in a high growth environment, so you're not looking for 3 and 4% rate hike cycles at the moment.
That growth rate must be scary, though, Ian. 0.7% now for this year. At some point there were some who had even suggested 2% for this year, 1.9% for next year, and then only 2% in 2020. That's still a scary figure.
It's a very scary figure, because if you actually think at our population growth in the country is about 2.5%, so per capita GDP is falling the whole time. But as you said, monetary policy is not the only driver of growth. We need fiscal policy, the budget to work as well. We need the economy to work to get back to reasonable numbers, and that's probably going to play out over time. But at the moment, there's probably limited scope what the SARB can really do to stimulate growth, and one of the ways is probably just to try and keep the repo rate at 6.5 for as long as possible.
We don't talk about synchronized growth anymore, Mamelo, because it seems the world is heading it in their own separate ways. At the same time, we obviously then can't talk about synchronized increases in interest rates by the seams of things, particularly if you take a look at us. should we then be looking at what best suits the local economy and not even talk about cycles when it comes to hiking or decreasing interest rates?
Yes, I think, look, when financial conditions tighten globally and we start to see the cumulative effect of an increase in the Fed rates.
Sure.
Ian mentioned at the beginning that our real rate is still attractive, but over time we're going to have to think about, as the Fed continues to move, how attractive does SA still remain in that context, but also in the context of EMs like Turkey that at 650 basis points that are increasing rates quite aggressively. While we don't have to be synchronized at this particular point, and perhaps we need to focus on SA specific things, we also need to be cognizant of not falling behind and being less attractive when investors are searching for yield.
A lot to really consider, but as we said there, the breaking news is of course that the Reserve Bank Governor and the Monetary Policy Committee have decided at a 4-3 vote to keep interest rates unchanged at 6.5% for the repo rate, the prime lending rate at 10%. Mamel Longwenya, Chief Economist at FNB, and Ian Scott, who is the Head of Fixed Income at Momentum Investment, join me after the break as well as we continue to unpack that decision. Do stay tuned.
SABC is